The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to Stock Tech. My name's Gaurav Sodhi. Joining me today is analyst James Carlisle. Hey, James.
Hello.
And we've got a rare appearance by John Addis. Welcome, John.
Hi, Gaurav.
For those who don't know John, John's the founder of Intelligent Investor, contributor, editor, the enforcer of punctuation and
Not
grammar.
with you, I've given up.
Yeah. I'm glad to see I've worn you down.
Do you know that I go into your articles and add apostrophes?
I was wondering where they came from. I don't see our relationship as being.
As well.
I think the tension there is between modernity and old-fashionedness. Really, I don't think it's between grammar and bad grammar. I just think you do things that just aren't necessary anymore.
No, there's nothing modern about apostrophes.
No, it changes the meaning of something.
Yeah.
Eat, shoots, and leaves.
Oh yeah, that book, I've read that.
It
was
didn't make
terrifying.
Much of an impression.
That was a scary novel for me. Actually, I found that really scary to read. But now, speaking of fear, actually, what a great segue, Johnny.
Yeah, that was a good setup on my part.
Nicely accomplished. We've been having a bit of a trot in markets, not so much in Australia, and I think some of us perhaps more than others. If you heeded the call to resources and you're decked up in energy, you're probably not feeling it as much. But JC, I dare say, growth investors are probably feeling a lot more.
I've been absolutely smashed.
Well, this is what I wanted to talk to you about, James. I think because we've had different experiences, but the sell-off is now getting pretty hard, and there's just a whiff of panic now. It's now universally accepted that interest rates are going to rise, inflation is rising. There's a compression of PEs. How are you dealing with it all in your own portfolio, James? Are you buying? Are you selling? Have you panicked yet, or you're too late to panic? Like, what's going through your mind? What are you doing?
Well, I think one thing you got to do is try not to panic.
I actually disagree with that, by the way. I think it's okay to panic as long as you panic very, very early. And I panicked really fast, and I actually have no problem panicking at all as long as you panic early. The worst thing to do is to panic.
I mean, panicking is that market timing we're talking about? Are you just selling things because you think that they're suddenly going to fall the next few months? I mean, I don't own things unless I think they're good value. I don't know whether they're going to go up or down in the next 6 months, but I just try to buy stocks which are good value.
You're talking too much sense. Look, if I'm honest, I hold a whole bunch of stocks which are a bit more speculative, which I don't know are good value. I'm just holding because I think they have really good optionality. Camplify is a good idea. I've been a shareholder in Camplify since just after the IPO, and I sold the whole position. I fully expected to hold that for a couple of years, but I sold the whole thing because I panicked, and I'm really glad I did. Dubber is the other one. Dubber, I sold my entire position in Dubber because I panicked, and I'm also glad I did. I just don't think this is the environment where we want to be holding unprofitable tech stocks.
So I guess the answer to that is that I don't.
You're more sensible, in other words.
Look. So I've been smashed because all the quality growth stocks have been smashed, but the ones I own tend to be the profitable ones. I suppose Ordinate would be an exception to that, but I think you can see a very clear path for it to make profits.
And I haven't sold any Ordinate either. Yep.
Yeah. So. Look, I think the thing is that you buy value, and I've made a conscious decision over the years not to invest in resources and not to sort of diversify like that, but they really do protect you at times like this. And I've just sort of taken the view that I can ride out market swings and roundabouts. Last year was very good. This year, has wiped out that and a bit more. If the market's not gonna, if the market offers you a good price for your shares, then you can sell them and buy something else. If the market doesn't offer you what you think is a fair price for your shares, you just hold on to them and wait for that value to appear over the years, which I'm happy to do. I'd rather it was all accelerated a bit by people offering me silly prices for the stocks I own, and then I can go and find something else. But if that doesn't happen, then you just have to be patient.
John, are you sensible like James, or are you a bit silly like me?
I don't know about this phrase "panic early." I think if you panic early, you're not actually panicking. So
Hmm.
if you sell before a big share price fall, you're probably not panicking because it's the share price fall that causes you to panic.
Yeah, no, you're right. You're quite right.
So I think you're making
Locking in profits is
a
yeah,
calculated, rational decision that the
mm,
valuation has become too stretched, and you're happy to be one of those people who think, well, I think prices are way too high. I'm just getting out because I feel uncomfortable about those high prices.
yeah,
The other perspective is to say, well, if you own a stock that you intend to hold for 8, 9, 10 years and it gets way overvalued, then there's a lot more work involved in trying to smooth out those fluctuations by picking where it's become overvalued and then buying in when
mm,
it's cheap.
mm,
I've just been knocked out of so many stocks when I've tried to do that. So
yeah.
my tendency is just probably more akin to what James does, which is just to hang on
Well,
and
yeah. Sorry, go on. Yeah.
and to ride it out.
Mm,
Yeah, I wouldn't. I wouldn't say that I just hold on. I'm a bit more active than that, I suppose. I mean, I was selling a few things last year. I wish I'd sold a bit more, But I guess the thing is that I sold a bit. Things were getting a little bit pricey in some areas, and I was happy to sell a bit, pay off my mortgage. And I guess the point is that I've got in a bit early on the way down, got back into a few of these things. I mean, I tend to have stocks that I'm very happy to hold for the long term, and I guess I sort of flex in and out of them as I see, as I get more and more greedy, I suppose. But I try to make sure that I'm getting greedy, more fearful as the price goes up, and more greedy as the price goes
yeah.
down, rather than
Mm.
vice versa, I suppose, is the point.
Mm.
In my portfolio, I've learned to just contain the ideas in different buckets. So there is a part of my portfolio. There are several stocks I own that I intend to own for a long time, and I'm not going to be shoved out of those positions easily unless something fundamental changes. So price probably won't be enough to get me out of those positions.
So what kind of
Um,
businesses are they? I'm sure the
Macquarie
listeners.
Telecom
Yeah,
is a good idea. I think Lovisa is another.
yeah,
Lovisa looked very expensive last year. It got up to well over $20, and even I
$22.
was thinking about selling it. But when I think about how much potential there is in Lovisa, how many stores it could open, you run that through even a rudimentary back of the envelope calculation. It's very easy to get 30, 40, $50 a share if
Mm-hmm.
you're patient, and they're executing really well. So I was quite happy to hang on to that. Aussie Broadband was one that was interesting because that had a huge fall. It fell, I think, 30% in a day, and I knew that looked a little expensive. But again, that's a business that I can see. I've compared it to Macquarie Telecom in the past. I can see it growing and morphing and getting better as each year passes, and I think that's one you want to hang on to for a couple of years at least. So I wasn't shaken out of that. But something like a Camplify or a Dubber, that is really not really a proven business model. It doesn't make money and still requires the market for cash flow, needs to tap the market to keep running, is an idea that is potentially worth a lot of money, but hasn't proven to be a sustainable idea yet. That sort of thing, I am more than happy to sell once the mood of the market changes. And I think the mood has changed. I think we're in a different world now. I think I don't think about prices and value in the same way as I did last year. This time last year, I think something has changed.
Which is.
Interest rates have changed everything. I think we're going to see um, multiple compression. It's happening already, but I think it's a permanent thing. I don't necessarily see all the falls as a obvious opportunity. I think JC, that's probably where we differ. I mean, um, I wanted to ask you actually, if you haven't been selling many positions, you haven't been shaken out. I get what you're saying. You own much better quality businesses, and I understand what you're saying. It's easier to and more sensible to hold on to those despite selling. But do you buy more? Are you
Well, that's
actually?
what
Yeah,
that's exactly what I do. I mean, I suppose um, to take Ordinate as an example, I'm trying to
yeah,
remember the numbers actually just while you were talking there. But I mean, my position size or the number of shares I hold in Ordinate might flex by sort of threefold. So when the share price seems when it was sort of $10, $11 last year, I
Yeah.
guess it was at a certain level, and I think I probably own 2 or 3 times as many shares now as I did then.
Hmm.
And I probably owned, that sort of level as well around March 2020. So,
Yeah.
as things go up, you sell a few, and as they go down, you buy a few more. That's the
Yeah.
way it sort of
Okay.
works for me.
Okay.
And look, as is the nature of these things, I tend to get in a bit too early. But
I think if you're paying attention, you're bound to get in
Yeah.
yeah,
too
Yeah,
early.
that's
So,
right.
so the ones I sold around $10, $11, I was sort of buying back around 7 or 8, and now I'm
Mm.
hurting. But at least I did that sort of slight sort of what do you call it? Slight sort of trade, I suppose. But and that's reduced the pain a bit.
Mm.
But I have the bunch of stocks that I'm happy to hold, and I sort of flex those. I've also been getting a few more positions in there, so I think it's a great opportunity to tidy up your portfolio, get some really high quality stocks in there.
Mm.
When I was thinking before when you sent the agenda around, and I was thinking ahead of the podcast of what I did in 2008 in the
Mm.
GFC. I ended up with a hugely concentrated portfolio. I was in 3 stocks at the bottom of that.
Wow. I think
But
Magellan was one of them, wasn't it, Jason?
Magellan was one of them,
Yeah.
yeah. And anyway, I sold that too early, or actually not.
Well,
Actually, I sold it for less than it is now. Actually,
Yeah.
my
it was,
final
it was
sale of
too early
Magellan.
about 9 months ago.
Yeah, yeah. But now you see that was when everything. I've got a bit more now, and my responsibility is a bit greater, and so I've actually been diversifying more. If everything's going a bit pear shaped, I feel as though I'd
Mm.
rather have a slightly broader diversification. So I've been taking the opportunity to add a few things like Domino's and REA and
Mm.
um, things that slightly different businesses. Breville I've bought, so slightly diversify out of the tech sort of sassy type sort of things that I tend to own.
Mm.
Can I just make the case for tech businesses
Mm.
amongst this very negative sentiment, which I understand is all based on price, not the quality of the business. But there does seem to be this idea that software companies aren't the kind of businesses we thought they were going to be because of these price falls.
Mm.
Do you think there's any truth to that?
I haven't noticed. I haven't noticed that. If you see that, that's certainly not my thinking. My thinking on all these software businesses hasn't really. I think our price guide on in my head, the price I've sort of thought about Xero hasn't changed since last year. A lot of these our price guide on Altium's the same.
Mm.
I think the market has changed. I don't think I've
Yeah.
changed. I mean, I swear, I think that they all did get pretty pricey last year.
I must admit, I probably was the least enamored with software, and that remains my position now.
Why is that? Why are you least enamored with software? What is it you don't like about it? And I know I'm
I
fully
think
aware that you're the one who's going to be asking the questions, but I'd just like to explore this argument.
Yeah, no. I think software gives the impression of stickiness and quality, but the resilience is really hard to tell, and everything looks like it's working really well until it's not. Um, think about the great software successes. They've all started with outside. The great software disruptions haven't come from competitors or big resourced corporations. They've come from people's garages, new ideas. Atlassian, Adobe, little small companies that were small come up with ideas, and it's an industry prone to disruption, and it's completely unpredictable, but it is consistent. And I just think you can easily fall in love with these businesses and think they're better than they really are because the metrics are fantastic, the economics are wonderful,
Mm.
but we can't really test the resilience of the product or the business itself. And you only find out that it's brittle after it breaks. And I've just seen these things break again and again, and it's led me to question how durable they are. I mean, there are different qualities. I mean, something like a Google, I think, is just
It's a different
impenetrable.
kind of business.
It's
Yeah.
a different kind of business. It's remarkable, but something like Facebook, I do question how good that is, really. When you look at what's going on there, and
That
there's a
begs the
whole lot of
question.
SaaS businesses beneath that I'm not that keen on. But anyway, yes. Sorry,
But that,
JC, go ahead.
well, I was just going to say that begs the question. I mean, because John started by talking about software companies, and you could talk more broadly about tech companies. And what is it? How are we defining all this? I mean, is REA one of these? Because
Yeah.
what it has is I mean, it's basically a software business. It has a
Yeah,
website.
it's
It
a
has
network
apps,
business, right?
It's a
but it has a
platform business as
platform.
well. Yeah.
It
Yeah,
has a network. So
yeah,
some of these businesses do have
yeah.
a lot of protection, and I
Of
would
course.
say Altium stands very little chance of being outcompeted by someone from their garage. It's not something you can just. It's hugely sophisticated. It's software. You can't just knock that up overnight. It pours millions into it each year, improving it. Um, Technology won't be another example there, and of
Yeah,
course Xero.
yeah.
Um, so look, I think that these businesses have more to it. No one's going to barge in on Xero, Intuit, and Sage. I don't think. Certainly not from their garage.
Well,
I
Zero
mean, look,
barged in.
well, Xero did, but
Yeah,
and that was the shift to cloud, and you're right
yeah,
that enabled them to do that, and you're right that there might be another technological shift that enables someone else to sort of barge their way in. Who knows? But I think that the point I'm trying to make is that it's wrong to dump all these stocks into
yeah,
the one basket, and when the market does that, as I
mm,
feel it sort of does from time to time, like right
mm,
now,
mm,
all the good stocks are being sold off with the
yeah.
bad.
No, I
The good
certainly agree with
stocks I
that.
think can be worth quite a lot.
Yeah,
And the bad stocks can be worth nothing, and the trick is to work out which one's which,
mm,
and that's not always terribly easy. And we'll come on to Xero, and we'll find we'll no doubt talk
yeah,
about that then.
Yeah. Before we do that, I would say that we think you can think about good software businesses, and good software businesses tend to be platforms.
mm,
Not exclusively, but they tend to be. And you can look at a business like Dover, which I think might be a platform business at some
mm,
point. Probably not a big platform business, but certainly have kind of network effects, I think. And then you look at something like Camplify and go, well, that could be a piece of rubbish. And there's 3 or 4 competitors, and who knows who's going to win that marketplace.
whoever wins will be a good business.
That's right.
I think, but
That's
we
right.
don't
And
know
you
who's
just
going to
can't
win.
tell now.
Yeah,
And it's
that's right.
and if they can get all of the vans in the world on their site, or half
Yeah,
the vans in the world on their site, then they're
yeah,
going to win.
mm,
Whether somebody comes along with a better site probably isn't going to overcome that obstacle in the same way that
mm,
somebody could come along and build a better site than REA, but if it hasn't got any agents or houses on it, it's
yeah,
not going to work.
yeah,
So
yeah.
the
No,
platform is a key point in all of this, I think.
yeah. And that just speaks to the competitive advantage, doesn't it? I mean, if the product itself is supposed to be just better, if the product is the competitive advantage, I think it's a weak one, even though it can appear strong at the time.
Yeah.
Networks, even scale. I'm not sure how what a big deal scale is either, but uh, it's tricky because something like Tech One, I mean, a single line of code software business, they make one change or one new development, gets scaled out to every single customer. That's very attractive. JC, I do accept your argument that there are different leagues in software, and I guess my skepticism is really reserved not so much for the Tech Ones and the Zeros, but for the tier two businesses, the ones that we've kind of looked at the periphery, but never really recommended, and they're the likes of Whisper, Nitro, Dubber.
Yeah.
I think these are
Yeah,
all actually
Live
pretty good
tiles.
businesses.
Yeah.
Well, Lifetimes was never on the thing on anyone's radar,
yeah.
I had
apart
to look at
from
it just because it was so bad.
it was so bad.
It's a
Yes, I
good
agree.
example of if you looked at everything about live tiles and thought,
Yeah,
well, I'll find this in other software companies, and you've probably got a bad software business.
yeah, and there's bad ones, and I throw Big Tin Can in that as
Yeah,
well. A bad, I think,
yeah,
a poor quality software business.
And
But
I
the
think
go
we've
ahead.
been quite
Yeah,
discerning. Sorry, I
yeah,
think we've been quite discerning over
yeah.
the last
I
few
think we have.
years.
Yeah.
I mean, possibly too discerning. We've missed out on one or two things that maybe we,
Mm,
with hindsight, we could have hopefully, preferably been in. But I think you've got to be, but the
yeah.
really high quality um, software tech platform, whatever you want to call them, the ones that sort of maybe offer a few of those things, I think can do very well. And a lot of them are half the price that they were last year. So
hmm.
I think getting
Yeah.
attractive. A lot of them getting very
Getting
attractive. Some
attractive.
of
I
them.
haven't bought a single thing in this downturn. It's really surprised me. Usually when prices fall, I do get quite greedy. In 2020, JC, you were the greediest man I knew at that point, but I was probably second behind you. We were buying a lot of stuff. I was raising as much money as I could to just buy anything. In 28 and in 2008, I didn't buy a thing because I was newish to the markets. Had a small portfolio, and I was completely struck by panic. I had no idea what to do. It was a real education for me. That was for me not really a time for action, but a time for learning. This one feels different to me than 2020. This downturn or sell off feels different, and I don't know whether it's going to be a time for action or a time of learning yet, but it feels a bit different to me.
Hmm.
What about you guys?
Um,
Are you is this the time for action for you, John? Are you
I haven't
deploying
bought anything
cash?
yet.
Okay.
There's a few things that I would like to buy, but uh, interest rates have been falling for what 30 years now,
30 years, yeah.
and that's a kind of generational change that we're going through, where people just have to acclimatize to the idea that rates are going up, and that's a massive, massive shift that affects almost every market, I think. And you can argue that that has already been priced in, I think, in some areas of the market, but it's hard to sustain that argument just yet. I think we really don't know.
I think what interesting thing is, so I'm
Doesn't,
just looking. Sorry, were you going to carry on?
I was just going to say that it just doesn't feel to be enough widespread panic at the moment to me.
Oh,
I would agree with that.
feels pretty
ARCs.
widespread in the stocks I'm in. The one thing I was going to say, so I'm looking right here at the chart for the US 30-year bond rate, which is basically the longest yield yield you can get. And since 2020, March 2020, that was down at 1.3, 1 point ish. End of last year, that was sort of 2, and that's jumped up now to 3. So it's added 50% in, so gone from 2 to 3, which is a pretty big move. But we're still very low. We're still back where we were in 2018. So it's and that's the market's best guess about where rates are headed. So a big shift to back where we were, let's say, for the period 2015 to 2018 is what the market's so far telling us. So whether that means, and we've had these rises. I mean, this is probably the sharpest rise in interest rates. The other one around 2012, there was a big rise. And remember, it got pretty bearish in 2012, 2013. And that was on account of a pretty similar rise in rates. But the thing I was going to say is if you're pricing equities, shares to return sort of 8, 10, 12%, depending on your fancy, and that's the sort of, generally we're sort of up around 7 to 10 or even 12 for some of the riskier stocks. That's what we're looking for, isn't it? If you then a 1% increase in the risk-free rate, how much difference does that make? I mean, I mean, look, it does make a difference, but I wonder whether it feels like there's a big there's interest rates, but we've had these arguments about interest rates before, and we're still a long way from where we were in the 90s or the 80s, which maybe means we're going to go back to those times, but that's not what the bond market is saying at the moment, and I'm not one to second guess that, really.
There's also the fact that, and we're going to do a story on this on Friday, but everybody's worried about the headline inflation figures, which there's good reason for concern because they look astronomically high compared to where they've been for the past 10 years. But I don't know what component is kind of sustainable inflation. Like energy might well be, and there's a lot of energy and food prices, so that might be. But there's still all those supply constraints working through. In Australia, the figures came out today. I think wages are up 2.4%, which is quite a strong number compared to what we've had in the past. But it's still not higher than inflation. And if labour is a big component to inflation, and what you really worry about is labour-driven, labour cost-driven inflation, doesn't seem like as big a problem as what the headline numbers might suggest.
Well,
I think energy.
Go on.
energy is a huge component of that inflation.
That's right.
You think about what's happened with China is the big cities in China are in lockdown. There is almost a halt to a lot of economic activity, and oil prices are over $100 a ton, a barrel, which I can't wrap my head around. And iron ore is still over what 120 or something, which is just these things. If you had told me that China was going to be in this sort of position, and I would have guessed oil maybe at 40, and iron ore certainly down at 50, like sort of half where we are. And I think what that tells us is that there's just a lot of constraint. There's been not enough investment in supply, in energy in particular, but potentially throughout that commodities complex. And I think input costs, particularly raw energy, those things could stay high for much, much longer than we think. And that could drive a 70s style inflation kick for a lot longer than what many people expect.
It's definitely a risk.
See,
Yep.
when you start talking about 70s style, I mean that starts getting very scary. I mean that's so the bond yield. Look, it peaked. I'm looking now the 30-year as I've got it in front of me. In 1981, it peaked at 15%. So, so if we got that, we'd be in trouble. But I think the thing to remember also about all this is we're talking about inflation, meaning higher rates, and that meaning lower multiples. But you've also got to remember that inflation gives a good kick to revenues. To revenue growth. So for companies with pricing power, it makes it easier for them to grow their revenues.
Yeah, it's a good point.
And if they have the pricing power, and I mean obviously they've got that cost inflation going on, but if they're companies which add value, it gives them the sort of flexibility they can ride that wave more comfortably. But the weaker companies maybe can't. And that's perhaps why it's considered good to have a bit of inflation in the system. Over the long term, they sort of target 2% because it means you have to keep sort of justifying your margins every year as you got to keep pushing through those price increases to keep your margins.
Gaurav, how much do you think the energy companies are profiteering in this environment as opposed to just passing on the resources costs?
Well, refiner margins have
Sorry.
expanded hugely. And you look at results coming out from Ampol and Viva Energy, they're looking very, very good. So I'm sure, and probably links into what JC was saying earlier, that in an environment of higher prices, it's easy to sneak through a little bit more margin as well. But that's not really where, this the fundamental lack of supply is the problem. And it's fascinating to me that despite these very high prices, we're still not seeing a supply response from oil or from coal. I think we are seeing it in LNG, we are seeing it in gas, but slowly and with protests. So this is going to be a big question for me. I think it's a really important point. If energy persists at these prices, then all our energy companies are extremely cheap. That's probably the best value part of the market for me, way better than buying tech or SaaS or even platform companies. I'd rather be in energy if those things are sustainable, if those prices are sustainable. And if they're not, well, I wonder what's going to bring down energy prices. It could be some sort of demand destruction, but then what do you substitute oil and coal with? These are big questions.
When you think of new oil and new coal, you think of new exploration. But how much capacity is there in the system to just simply pump or dig more from existing supply, existing mines and existing wells?
I don't know, but I know that there hasn't been any capex for it, and it's been longer than just the last few years. It's probably for the last 10 years. In oil, we've had a couple of very big sell-offs in the oil price, and it just scared a lot of investors away. Oil in the swing producer used to be the shale guys in the US, and the banks have really tightened their lending on shale, and shale investors have demanded dividends. Everyone thinks this is a sunset industry, and so they're investing and treating it like a sunset industry and demanding dividends, buybacks, and not accepting capex at all.
Wow.
We've seen the success that BHP has had. BHP went from being a stock we all used to laugh about, really, about how bad capital allocation was, the butt of all our jokes. and now it's one of the best businesses in Australia. And the difference has been how they've treated capex. And the result of that is that you get much better returns as a shareholder, but the entire industry suffers from poorer supply and arguably keeps prices higher for longer. The point I wanted to make earlier, actually, just on the cycle was, my experience with cycles is that every bull market has its flag bearer, and it's kind of its mascot. And before the market turns, you need to see those flag bearers fall. And for me, those are crypto, Tesla, and Cathie Wood. And I think for me to get more interested in buying into all the pessimism, and there is rising pessimism in tech, you're going to have to see crypto fall a lot more than it has already. Tesla has to fall a lot more. And the ARK ETF has to start experiencing massive, not just falls, which it already has, but investors are still piling more money. She's actually still attracting a lot of inflow. That has to turn around. Now,
That's probably
not
me and James,
scientific.
I think.
It's probably James. Look, I know it's not scientific, but I think when the longer you do this, I think the better your gut feel tends to get, and that for me is one of my tell points. I used it when in the last resources bust as well. It was when we started seeing Fortescue almost go out of business. The big the star of the last resources boom almost going out of business. That's when I think that signaled a time to buy and close to the bottom. And I think the same is true this time. We're going to have to see those three icons fall heavily.
Fair enough, but I don't think crypto's got anything to do with Altium or Ordinate. So if and who's to say that we actually have to get to that, that bottom point? I mean, there was a big sell-off in 2018, and you don't always, sometimes the market bounces off a level and you just forget about it, and it wasn't. I don't think we'll forget about this in a hurry, but I won't. But I don't think you've got to presume that you're going to get to this point of capitulation. And I'm certainly going to. I'll be all in long before we do. Or maybe I already am.
Double all in.
Yeah.
Well, Microsoft, let's not forget, took 10 years to reach, or more than 10 years, like 13 years to reach its pre 99 high, right? After it fell again after the bust. So, look, logically, what you're saying is correct. I can't argue with it, James. But 10 years, even you might say, well, that's what's that in a lifetime of investing? I still think it's a long time, and I think,
especially if you're 65 or something,
even if you're 40, John.
But if you halve and then double again, right? Then then 10 years is 7% a year, which is not too bad. So the key point is that a lot of very good stocks are half the price they were a year ago, and one shouldn't ignore that.
I think you should forget about what they were a year ago. I think that was that in
Oh,
hindsight.
well, possibly. All right, but look, all I'm
back at
saying is relatively. I mean, look, I mean, look, you're absolutely right, but I'm saying they're relatively more attractive than they were a year ago. I mean, I'm saying we weren't buying many of these things a year ago, or any. I can't think
that's
of
true.
any.
Yeah, we weren't even looking at them. Yeah.
So
So we could all be holding sort of little Aussie versions of Cisco, which reached, I think, a high of what, $68 around the time of the .com crash, and has never breached that since.
Never gone back. Yeah, that was the biggest company in the world at one stage, wasn't it?
Yeah,
that's amazing. Now, two of these stocks that we have been looking at, I think, and there's consensus that these are among the areas of interest. And JC, these stocks are yours. I think almost unsurprisingly.
Well, REA is Xero. We don't cover, but I've been looking at it and wrote it up recently.
Yes, that's right. So let's start on REA. I think we all reckon. Well, I reckon this is the single best business in Australia. I don't think I get too much argument that it's in the top 10. I don't think I get too much arguments in the top 5. It is one of the best businesses in Australia. The price has fallen a long way. JC, we must be getting pretty close. I think you've upgraded it already. Have you bought it yet? At what point does this become just a table thumping buy? When do I
Um,
buy it is what I want to know, James.
well,
I want to know that too.
yeah, it has been upgraded. Our buy price for a while has been 120, and it's got a bit below that. Actually, we increased it sometime last year, but it's got below that, and yeah, it's I think a good time to buy it. It's not a table thumping buy. I've bought, I suppose, for my own portfolio, a starter position.
Hmm.
I think that below $100, getting towards 90, I'd be starting to thump a few tables. Um, the so the forward PE is around about 35 now,
Hmm.
and I think if that got below 30, you'd certainly start getting quite excited. And again, this is a classic example of a stock which there's some multiple compression, but if that's because of inflation, then
Hmm.
that revenue growth. I mean, so I'm
Hmm.
looking for revenue growth of around 10%, I suppose, and earnings growth a few percent higher, sort of maybe 13 to 15%, that sort of thing. Um, and that'll be a whole lot easier to. I think that's very attractive on a P below 30.
Hmm.
I mean, less attractive if rates go up, but the inflation makes it that much easier to achieve, and you could then start to talk about growth maybe a few percent higher than that, because it's going to be easier for it to push through those price increases and that sort of thing. And this is a stock which has that pricing power, and I think that's an important point.
Oh yeah, proven pricing power. They've raised prices relentlessly over the last decade.
Yeah, but they've done that by adding more value as well. I
Correct.
think that
Yeah,
their
no, I think that's right.
customers feel that they've been giving them more, and they improve the product the whole time. Um, but they're still making a very small, well, not very small, but a relatively small part of the fees on a housing
Yeah,
transaction.
absolutely. I think
So
that's the key,
there's
actually.
and you could say they add the most value in that
Yeah,
whole
correct.
process,
Hmm.
and so there's a fair way for them to go.
Hmm.
They've got other areas to grow in as well, sort of sidelines in financial services, mortgage broking, overseas markets which are perhaps less developed, India. But the core Australian business is why you buy it. That's the one
Hmm.
that's really strong, and yeah, the P around below 35. If that got into the 30s, I think it's a really good opportunity, because there aren't many better businesses you can expect to grow as reliably as this one.
Yeah. No, I like that point about where they sit in the value chain. When you consider the take that's paid to real estate agents and the value they generate compared to REA,
Hmm.
there's a lot of room there. And they could
Yeah.
either do an FTV style, one day they could turn into more of a transaction platform, not just a listing platform. And I think that's interesting as well. I don't think they've said that out loud for many, many years. I once heard an executive say that at REA and quickly pedaled
Yeah.
backwards. Didn't want
After
to. Yeah,
thousands of brokers called
that's
him
right.
to abuse him. Mm.
That's right. I think the brokers actually they tried to set up their own rival at one stage and it just didn't work. But yes, there are good reasons why they are a bit secretive about
Yeah,
how far they can ultimately go.
but I think
Um,
that they're constantly extending their tentacles, if you
mm,
like. There's this new website, property.com.au. I don't know if you've seen that, but it's you type in any address and find out the value of the house, or
wow.
an estimate thereof, and local recent sales and that sort of thing. And it's pretty basic so far, but it's just an interesting development. Provides good data,
Mm,
and in other areas you can get, if you register for the site, you can get sort of weekly emails telling you what they think your house is worth, and
mm,
that sort of thing, and
mm,
and if you've got that sort of interaction, you're more likely to refinance your mortgage. And there's just they're just the technology is being developed, and they're extending their tentacles, and there's just a lot of ways they can monetize that. And
mm.
uh, they've got the network effects going for them. It's a great business, and
One
it's
question I've had
growing
about it.
pretty reliably.
is just about the cyclicality there, James, because we've never really, I don't think this has been properly tested, and I don't know whether listings are cyclical. I mean,
Oh,
logically,
they certainly
you'd,
are.
they'd have to be, right? Yeah,
Yeah,
yeah.
yeah, yeah.
So
They
it's
had a
never,
very.
we don't know what happens.
Oh well, yeah, but it depends how bad you want them to get. But
Mm.
I mean, they had a pretty nasty listings downturn in sort of 2018-ish. I
Yes,
forget the
that's right.
precise dates. And the stock got pretty cheap.
Mm.
And that's arguably what's happening now. I mean, people are
Yeah,
talking about listing falls next year. So when I
yeah.
say reliable growth, I mean long-term reliable growth. I mean from
Mm.
year to year,
Mm.
that listings, if listings contract in a year, it's going to be hard
Mm.
for them to grow much. So there's a few swings there, and that's perhaps what gives you the opportunity. So
Mm.
that probably is what's happening now.
John, what do you reckon about REA? Is it on your list?
Yeah, I'd love to buy it. I really
Yeah.
would. I suppose the limit is how much of the take can REA grab from the brokers.
Mm.
That's the cap. Obviously, there's only a limited number of houses in Australia that they're not growing particularly quickly, but they're growing at, let's say, GDP growth. So for a high growth business, there needs to be that pricing power. And to me, that seems to revolve around being able to squeeze the brokers a little bit harder without them realizing they're being squeezed, which seems to be, from REA's point of view, just the delivery of new and new levels of products that allow each property to be displayed in a different kind of way. Would that be right, James? Because that seems to me to be where the growth will
Yeah,
come from
that's
over time.
sort of. I think you're missing out, or possibly missing out, one component there. Because you talk about GDP growth.
Mm,
So the housing stock, I think, grows 3 or 4% a year.
yeah.
But prices grow also, and so as the prices grow, they get a free kick in terms of what they're able to charge. So that what brokers are getting then is going up as well. I mean, estate agents. So as the as the value of a house goes up, 3-5% a year, that should ultimately flow through to the revenue growth as well, I would say.
Mm-hmm.
So you got the two lots of 3 to 5%, and then you got some actual real price increases on top of that, sort of, as you said, squeezing the broker without them realizing they're being squeezed, which is partly to do with adding value, and partly to do with just saying that we're very strong and you need us. And if adding all those components together, I think you can get up to 10% quite easily.
Mm-hmm.
And I think that the costs probably don't increase quite as much, so you can get earnings growth. I think well into the teens. Really, that's the bull case, and
Yeah.
I think I mean so and that I feel is quite sustainable long term, but it's a question of I mean at a PE of around 30, let's say, I'd say that's pretty attractive, but others don't like to pay so for growth so far ahead. So
JC, I would have expected REA to be spitting out lots and lots of free cash flow. What do they do with their excess cash? Are they reinvesting that? Do you see a time where this would be a business that would ever just spit out cash flow? Or does it
well, it
require a
makes
lot
pretty
of?
good cash flow already, but it
Yeah.
does capitalize some of its development expenditure, some of it, but the cash flow is a little bit less than the profit, I think, but it spits out pretty decent cash. I don't think there'll ever be a time where it stops investing, because that's what it's all about.
Okay. They don't pay out a lot,
So
do they?
yeah, what's that?
Do they? They don't pay out too much, do they? In dividends.
Oh, look, no, they don't. But I couldn't tell
Yeah.
you the exact payout ratio. I mean, yeah, that's right. No, they don't. But I couldn't tell you the exact payout ratio.
Anyway, I'm trying to find it as we speak. You can probably hear me clicking away, but not as stealthy as I thought. Yeah, it's only 1.5%. Yeah, but I think that's probably a function of the very high price,
Yeah,
right?
but
If you're
that's
trading
the
at
high
30
yield.
times.
So the payout ratio is, yeah, that's right. I mean,
Yeah.
I think it's reasonably high. Yeah.
Okay. Okay. Um, All right, should we move along to the next one, which is relatively new for us? We've written about Xero for quite some time. I don't think we've ever upgraded it. In fact, I think REA, this is the first time we've upgraded REA, isn't it, JC?
Yes, it is. Yeah.
Yeah, that's quite a milestone. Of all, for all of us loving the business and singing its praises, it's actually the first time we've ever bought it. That's interesting. Now, we haven't had that moment with Xero yet. Everyone, for most people I speak to, Xero um, is the best software business in Australia. What is it about Xero, James, that just makes it so lovable?
Well, I'm not sure that I agree with that characterization. I don't know that I would call it the best software business in Australia. I think well, again, it depends what you call a software business. I'd say Altion's better. Um,
It's
Isn't
but
most
that?
well
I mean,
known though.
the most well known, yeah, and look, it
Okay.
has a lot of fans. And the
Mm,
thing about Zero is that it's just hard to know how strong it is, really. And there's the difficulty.
mm,
It so what was attractive about it a few years ago is that it sort of got into this cloud based delivery of accounting software
mm,
ahead of other people, and that gave it a couple of advantages. It made it much easier to use this sort of partner led distribution model where they get the accountants get rewarded for getting their customers onto it.
mm,
And it also made it easier for them to sort of uh, become a platform onto which other software companies could make
yeah.
software to to augment it. And all of this sort of was assisted by that cloud delivery.
Mm,
And some of the competitors were held back by the fact they're still operating legacy on premise products.
mm,
So it absolutely hit the market with a bang and did very, very well, particularly locally, Australia and New Zealand. Um, but obviously, the others haven't been asleep or weren't asleep for too long. They got woke up pretty quick, and they've been now, focusing on their cloud products and their, and the difficulty is, I think the difficulty I find is knowing quite where that's at. So how much of that lead has now been eroded? I suspect pretty
mm,
much most of it. Um, and yeah, so it ultimately is quite a competitive business if everyone else is now doing the same thing and they haven't got anything to, um, any particular competitive advantages. But they're still growing very rapidly. They've got
Where is that
large
growth
parts of
coming
the world.
from? Because I would have thought that in Australia they're largely tapped out. I would have thought. I don't know if they're still growing here, but I'd be surprised if they
No,
are.
no, they are still growing here. Still
Yeah,
growing here
They're
pretty well.
growing at
Yeah.
not much
Sorry, go on,
different
John.
rates to the UK and North America.
really.
They're growing at well in the last results it was 26%, wasn't it,
Yeah.
James? I think.
I couldn't tell you exactly.
And
Yeah, but I mean,
is that from the platform? More transactions on the platform, revenue rising from existing users, or is that just new users joining Xero?
well, I think it's a bit of both. It's a bit of ARPU, and it's a bit of so that's revenue per user, and it's also subscribers increasing.
Mm,
The number of so you've got a situation where it's not just their market share; it's also people shifting. So people are shifting onto the cloud. So once so there's a an available market for them there of people who are just getting to a
okay.
point where they want to shift onto the cloud, and because
Right.
they don't have any interest in the market where people aren't yet on the cloud. So
Mm,
you've got that sort of tailwind for them. Um, but long term, I suppose the recent result was quite interesting in as much as subscribers were slightly disappointing, subscriber growth, particularly in the UK, and
mhm.
but the ARPU growth, the revenue per user growth, was slightly higher than people were expecting, and I think that may be that's what I read in most of what I've seen around the market since the result has had people increasing their expectations for ARPU growth and knocking down their expectations for subs growth. But
Mm,
but ultimately that keeps you with similar sorts of revenue growth. So yeah, I mean it's still in the last 5 years. I think it's grown 30% a year revenue,
mm,
which is
okay.
pretty pretty remarkable. So it's certainly one of Australia's fastest growing software businesses. But whether it's the best, I think the jury's out, and that'll. I mean, it probably to grow to satisfy the bulls. It's really got to make some headway in America, which it hasn't really yet done.
John,
And
why is that? I mean, when they first went over to America, there was a promise of very quick gains. Intuit has really crushed them over there.
Yeah.
Do you have any insight into why that is?
I think Rod Drury made a bit of a mistake when he came out and said, we're going into the US with all guns blazing. And very promptly, Intuit came into Sydney and plonked about 50 staff into an HQ in Australia just to take Xero on and make life more difficult for them here. So that kind of shows the aggressiveness of their competition. Intuit also runs the TurboTax product, and they've just been fined by the US government for a ridiculously misleading website that gets people to pay for a service that the government says should be free to people, provided by Intuit. So they're a very, very aggressive competitor, and you can't tell from the results. Like James and I have been through the quarterlies, and they seem to offer more SaaS kind of metrics. But this is not uncommon for software businesses, non-US software businesses, when they go into the US and they expect the same kind of metrics from their domestic markets, and they just don't seem to happen. And we've seen a shift in the US, I think, in the way that they're selling. So the acquisition costs in the US are far, far higher, and that shouldn't really be a surprise because Intuit is so embedded that all they had to do was just to get on the cloud fast, and that would probably be enough to hang on to their customers.
Which is exactly what they've done, right?
Which is exactly what they've done.
Yeah.
The products, in terms of functionality, from what I know, aren't hugely different. I think Xero's marketing is pretty good, but in terms of the user experience, I'm not sure how much better Xero is or whether it's better at all. But to get those customers to leave Intuit, they'd have to have a significantly better customer experience, and I'm not sure that they've got it. So to get customers to come over, you're probably having to spend more money. And when you look at the CAC, the customer acquisition costs in the US, it seems to me that they're spending a lot more to acquire a customer in the US, and they're finding it harder to hang on to them. So recently, they've just announced they're going to use a third-party seller and walk back from where they were in terms of growing their US presence. And also, I'm just looking at the investor briefing from the full year results, and on page, it's quite interesting. So on page 9, they have their international highlights, and North America looks good because revenue's up 28%, subscribers up 19%. UK revenue up 30%, subscribers up 18%. And then you go down to slide 11 and it says investing in our strategy North America. And then there's a whole load of graphics about the Canadian product. So they've really it looks as though they're handing off everything that they do in the US to these third parties because they basically acknowledge that they can't really crack it and get the kind of numbers that they need to be better than Australia or anywhere close to what they're getting in ANZ. The UK looks more promising from what I can tell.
But had a disappointing half in the UK, and I think people are not quite sure that there's a making tax digital thing that they've that the government's pushing there, and people were expecting some quite good numbers there, which haven't quite come through. So, but I mean, ultimately, these are all short term. These things are sort of swings around. Well, what you were talking about there, John, I think is the important point. I mean, where they start weak, it's much harder for everything else to fall into place. The partner-led distribution model works much better where you don't have big competitors. Where you're the one and only cloud product, you can go into an accountant and say, look, here's this wonderful thing. You can hook up with all your clients. And the accountant says, well, obviously I'll have that. But it's a harder argument to make where that accountant, is familiar with Intuit, and its customers already, some of them already use Intuit, and and they've got a cloud product as well, and so it's going to be much harder for them to make headway, and the valuation of the stock is so sensitive to how well it does over there. It's just very, very hard to value, and that's what you see in the volatility of it. And I guess that's why we would want a very decent margin of safety. It's not, look, it's hard to know what the value is. It's hard to know what constitutes a margin of safety. I sort of floated 80 as an interesting price when I wrote it up a few weeks ago, and we did just dip below that after the result. But look, whether I think we're not rushing to upgrade it. If we want it to come and sort of break our door down.
Do they make a lot of acquisitions, JC?
They've made a few, just sort of little bolt-on things. Plan Day, I think, was the biggest one they made recently. That was last year, and that just the little things to augment the product and help to increase the ARPU. And
didn't they do that with their payroll as well? Didn't they buy a payroll solution too?
Yeah, they did. I can't remember what it's called, but so they make a few things, but not.
They generate very good cash flow, as you would expect, right, from a business like this. Yeah, but I'm just surprised at their investments as well look very high. I assume these are acquisitions.
Well, it depends how you're looking at it and what. I mean, they capitalize. So they capitalize a lot of development costs.
Yeah, I can see that.
You're probably seeing that.
Well, there's a big amortization line which wouldn't come through in cash flow, but there's a purchase of intangible assets line as well. It's quite sizable. So 200 million last year, 150.
Yeah, well, they made a big put. Yeah.
Is that to augment the platform side? I mean, I know they're trying to build out their platform.
Yeah, that's exactly right. Yeah.
Okay, right. Yeah, so that seems like quite good use of capital in that sense.
Yeah, it is. It's all good. And I suppose fundamentally the point is that they're guiding towards spending 80 to 85% of their revenue on in terms of costs, that doesn't leave a lot at the bottom line. So that at the moment their focus is still very much on grabbing market share and growing and getting subscribers, and so all the value is left to the future really, and that's what makes it so hard.
I've got a couple of questions for James on Xero, and maybe this is just an inherent bias in English-speaking world, but when you look at a business like Facebook, which I know that Zuckerberg like to think of it as a platform business, but it's really not. It's just an advertising business. Xero is kind of a platform business in a conventional sense, and a little bit like REA is. It's not like a multiple platform business like Google, but it's still pretty good. It was very easy for Facebook to break into non-English speaking markets and grow at the same kind of pace as it did in its home market. Why haven't Xero tried to go into France or Germany or places like that? Why have they just stuck with South Africa, Canada, the US, UK?
That's a good question. I mean, I think it probably comes down to how much of the R&D is country specific and how much of it is sort of core product specific, if you like. So if 100% of the design and development was the core product and you didn't have to do anything to tailor the product to any particular market, then you'd obviously go for every market in the world as quickly as possible.
As did Facebook.
Yeah, well, and I think that's the thing, isn't it? So because it's not just language either, is it? It's also tax law and various other bits and bobs. So the product has to be tweaked for different markets, and they need to be supported by different add-ons, and so I guess at the moment they've got enough on their plate, I suppose, is the answer to that. I'm afraid I can't give a better answer than that. But
so where are you on Xero, John? Are you
Well, I wish
Do
I
you
bought
own
it
it?
when it was at 11.50 when was the first time I got familiar with
Yeah,
it.
yeah,
When it was going through a similar, it's not going to grow as fast as we thought.
that's right. I
When
remember that.
that must have been 6 or 7 years ago now, I think.
Yeah, yeah.
When it went through had a period of sort of low growth. Um,
And it
a
was
couple
also
of
when SaaS accounting was new, and I don't
Yeah, that's right.
certainly I
People
didn't
didn't get it.
understand. I didn't
No,
get
the
it.
people
I
didn't
think we
get
didn't
how.
understand how how good it would be to be on the cloud and how strong, how big a differentiator that was.
Yeah.
Mm.
Well,
And so
the
the
business was
arguments then
telling
were
us.
slightly different
The
than they
business
are
was
now.
telling us, but it didn't translate into the numbers. And for me, anyway, I just viewed that with skepticism because I didn't see it. And the truth was
Yeah.
that we just didn't know how to tweak the the official numbers to reflect what was actually happening inside the business. And I
I'll
think we
have
know
to.
that now.
I'll tell the listener the story when the iPad came out and Gaurav came in, because it's kind of illuminates a company like Xero, I think.
Mm,
So when the iPad came out and Gaurav said, "Why is everybody getting so excited about this? It's just a big iPhone." And it was just a big iPhone. But the thing was, it radically transformed the user experience in different use cases. And small business accounting software had a similar kind of effect. So moving to the cloud
mm,
radically transformed how you could manage your small business
yeah,
through making payments on the bus on the way to work,
yeah,
through making it look much better on your screen, through knowing that once you'd paid something on the bus, it was going to register when you got into the office and you opened it up on your desktop computer.
mm,
So that radically transformed the user experience, which I think was what was Xero's great breakthrough idea. In terms of user experience, once you get past the login screen, it's really not that great. But accountants aren't that demanding in terms of UX.
mm,
But what I think what happened was that the longer that time went by, there are companies all around the world in smaller markets who saw what Xero was doing and made that migration to the cloud.
mm,
And it might not be good enough. It might not be as good as Xero, but it's good enough for the users. So as the more that time passes by,
mm,
the harder that competition gets. And that's what we really saw in the US, I feel.
mm,
That entrenched market, not quite as good a product, but good enough, made that migration to the cloud. And now they've really backed off that marketplace. So if I was Xero, and I'm obviously not, and I probably really don't know what I'm talking about to what they're talking about, but I would look for markets where you have really, really weak, entrenched products rather than just go on the basis of market size and English speaking.
Well, what they say, I mean, they say about the US that the cloud penetration there is actually very, very low. I mean, Australia and New Zealand have very high rates of cloud penetration for accounting software, and I think that's one of the reasons they still feel that market is very attractive, is because
okay,
there's a lot of accountants which need to get online,
mm,
get into the cloud, and so. But I mean, of course, they're fighting there with a strong Intuit product, and that's possibly the difference. So maybe they need to look where there aren't those competing products. Maybe that's
yeah.
the answer.
And churn rates are very low here, right? So you sort of need that migration to get customers. Otherwise, why would a business? It's such a difficult thing to switch all your accounting software over. You probably
Mm.
don't get too much
I mean,
churn.
churn rates are incredibly low.
Yeah,
That's probably the most attractive thing about this
I
business
agree.
is once
Yeah,
you acquire a customer, they really stay with you.
yeah,
Well, they're about 10% a year, right? The
Yeah.
churn, which I mean, compared to some other stocks, is relatively high. But I think the important thing to understand with that is it's mostly. I mean, the average life of a customer is almost 10 years, and I think the average small business only stays around for 5. So
yeah.
that they've most of their churn, I think, is actually companies going
Correct.
out of business
Yeah,
rather
yeah,
than
yeah.
deciding to use a different product.
It's the same for data centers. The only churn you see is when the business actually goes bust, and
Yeah.
yeah, it's very attractive. Listen, gents, we have to. It's been we've been babbling for an hour. We need to wrap things up. So let's come to a conclusion about Xero. John, would you buy? Have you
I'd
bought?
like to buy it, but not yet.
Not yet. Okay, and JC, you wrote an article about it recently. It's getting very close to your buy price. What are you thinking? Are you ready to
Well,
pull the trigger?
Um, I'll keep umming and ahhing. The more you and ah in the current market, the better it seems to
The
get.
more
But
you're rewarded, exactly.
yeah, seems to be. So look, I said 80. If I am an ah a bit, maybe look, I'd be very tempted around 70, certainly. And maybe you want to wait. Maybe it's worth waiting till you're very, very tempted rather than just feel it's looking good. Yeah.
The message I'm hearing from both of you, though, is that the type of stock to really be looking at is in that top tier. Is the REA, the Tech One, the Xero, Breville, Altium. These are the sort of things that I would concur with. That these are the sort of things I think are going to be interesting. That's where my attention is going to be focused as well.
That's quite a good comparison, because you can look at REA and say, well, whoever's really running that, you know what they have to do. It's quite hard to stuff up.
Yeah.
Xero is still very much Rod Drury's baby, I feel, and he's the one who's still driving it, and it's his life's work, and that makes it susceptible in some ways.
Interesting. We'll have to delve into his psychology and put him on the couch a little bit later. We'll leave that for JC, actually.
Yeah.
Right. Any last words? We should wrap up.
No,
you'll notice. You'll notice that I did not bring Cole into this conversation once.
You just did. You ruined it.
Well, I wanted to quickly, actually, I wanted quickly to say that I redid some Cole numbers 1 or 2 days ago, and I'm now getting spot free cash flow for Woodside, for Whitehaven of about 80%. So I'll just leave it at that. Jeez. I'm getting 80% free cash flow yield for Whitehaven. So that's why you can understand why I'm sort of looking at your Xero and REA articles and probably not getting as excited as you blokes are getting excited.
Yeah. Yeah.
All right, we'll try and go next time without any mention of Cole whatsoever. I'll do better. James, thank you very much for joining me today.
Pleasure.
John, it was great to have you on. We need to do this again.
No, thanks, Gord. I enjoyed it.
For everyone else, thank you for listening.